Hello, Brett Ethridge here, co-founder of Franchises for Fathers, joined today by a special guest, Al Lesko, founder of Fund My Franchising. We're going to have a conversation today about money and how to fund your franchise investment. Al, welcome to the show.
Oh, thanks for having me. I appreciate it, Brett, and glad to be a part of this and hopefully educate some of the people out there.
Including me. So I have questions that I'm asking in part because I want to know some of these answers. I find that the funding aspect of the franchise award process can be very confusing to people. It can be scary to people. I think it can turn people off to even pursuing franchise businesses because maybe they think they don't have enough money or how could I ever pay for it? And so those are the conversations we're going to have. And I want to start by asking you, Al, maybe just a little bit about your background. We're going to sort of lay some foundational work in terms of answering, I think, some common questions about the funding process. And then for the listener, we're going to play a fun game called Myth versus Reality and either debunk or confirm some common questions, misconceptions, perhaps, about the funding process. But Al, you've been on really all sides of franchising. You've been a franchisee, you've been a franchise consultant, and now you're a funding expert. I guess you've always been a funding expert, but maybe just talk a little bit about your process and journey to get to this point in franchising.
Sure. Well, I came out of corporate America. I worked in operations, worked for a publicly traded company, worked for a mom and pop as well. But my experience has always been strategic. Uh, uh, with corporate America, I was hired to go in and fix the problem stores, analyze it, fix it. So that's just natural for me. When I wanted to leave corporate America, I went into the franchise industry. And like you said, I bought a couple franchises, I sold franchises, but really what drew me to funding is the process. I found, to me, for my own clients, I didn't feel that, no knock against my competitors, but they just didn't have that competitive edge that I think the clients needed. And that was basically to put together not how do I get funding from one source, but put together a plan for me, go over each plan and tell me which one makes the most sense. And that's when I put together Fund My Franchise. That was founded in 2012. So I've been doing it quite a while. And anyway, that's what brought me here today.
Yeah, and that's what I think I've enjoyed in terms of our working relationship and what you do with candidates, clients, is really take that bigger picture, holistic consulting approach to it. There are different ways to potentially fund a franchise, and you're all about strategically which is the right for you, given your different assets. And so maybe I'll start there. Before we dive into the myth versus reality, what are three or four of the most common ways when somebody is going to make an investment into buying a franchise business? What are their options? What are the most common ways that people do that?
Certainly the number one would be an SBA loan, whether that's going to be an express loan or if it's going to be a 7A or any other type of loan. The second most common, once you explain it, if you're talking to a strategist, would be a IRA 401k ROBS program where they can use it either to solely fund a franchise or in combination with an SBA loan. The third option, which is a good option if you know who you're dealing with, the reliable and a credible source, would be term loans. And then, of course, the fourth option, well, there's actually five. Another option which makes sense depending on the economic times and depending on the size of the loan and the individual person would be a either a cash out homeowner cash out or HELOC. And then, of course, the worst that I always recommend not doing is the credit card stacking that used to be a lot more common back then, but that is not recommended at all.
Is it ever recommended just to pay cash? I talk to candidates and they're just sitting on a pile of cash. People have money. Why not just write a check for the franchise fee and the initial startup costs?
That's a good point. There are special circumstances, but let me give you a quick scenario. Let's say somebody wants to leverage cash. Okay, they start their business. Let's say they're in a good position. Now all of a sudden their business is growing quickly. Maybe they get a chance to buy out a competitor. Now they've leveraged all of their cash and they may not be in a position to do that when it could mean expanding their business to, very, very large scale. So that's one example. The other example is you lose the benefit of offsetting profits by not being able to take those deductions on the loan payment. You miss the opportunity on the interest. And like I said, I think to me, cash is king. Sometimes you run into a situation where you thought you were going to have enough money and now you don't. And it's a lot tougher to go to the bank after you've already spent your money and say, I don't have enough money. And all of a sudden they're saying, well, why did you come to us in the first place? Now's not the time.
Right. Although at that point they would have an existing business, I guess, that could be collateral for the next loan to sort of scale and add some.
Sure, as long as they've established it, they're still considered a startup. And a
Yeah.
lot of times, and many banks are going to want to see 2 years of good tax returns out of that business before they're going to go forward. Puts them in a situation where they've got to go get a personal loan or a term loan or the home equity line.
Just so we're all using the same terminology, you mentioned SBA, Small Business Association loan. I think people are maybe loosely familiar with that. People are familiar with HELOCs, term loans. You mentioned a 401k ROBS program. Maybe you can just briefly summarize what that is, how that works, because that's one that I find a lot of my candidates don't know about. They never knew that existed as an option. And then sort of a two-part question. So briefly summarize that. Are any of these unique to franchising? Is there anything about any of these funding options that's unique to franchising, or is this all stuff people could do investing in any business?
Um, the ROBS program is rollover for business startups, and it allows you to have or have created for you a retirement fund that actually invests in your business while still allowing you to invest in stocks, bonds, mutual funds, gold, silver, even liquidate in cash. You have much more flexibility and control over your retirement plans. Good case in point, if the economy's not doing well, your stocks are starting to come down. Just heard this the other day. The lady was kind of panicking. And I said, well, you can always liquidate that to cash, have it sit there. And when the market, if you want to try to time the market, which, that's another conversation entirely, you can just leave that there. So it gives them a little bit more freedom and flexibility, as well as if you're not happy with your advisor. But the real opportunity is having your business owned by that 401k, at least a large percentage of it, either initially or when you go to retire, because the big advantage there comes in of saving on capital gains tax. There's a real advantage there, and we can get into that at some point.
Yeah. Okay. Well, let's dive in. So let's go through just a few. I'm going to throw out a few statements, and I just want you to explain whether it's a myth, whether it's a reality, are there kernels of truth in it, and just what do we need to know about these concepts. And the first one I'll put out there is you have to be a millionaire to buy a franchise business. A little bit tongue in cheek, but the
Oh,
point is, do you have to have a lot of money to be able to invest in a franchise?
no, not at all. And it depends on the type of franchise you're looking at, especially if you're looking at service related franchises. There's a number of opportunities out there for less than $100,000 that is really only going to require somebody with good credit, a good history, some savings. They get into that for 10, 11% money invested in their business. It's not going to the bank, it's their money, and showing that they have a little bit of a reserve account, either cash, stocks and bonds, IRAs, or 401k. So that's a myth.
Yeah. And I think it comes from people think about McDonald's, right? We have all heard $1.5 million to buy a McDonald's. But as you suggested, there are a lot of
Mhm.
other good options. You threw out some percentages. My next one is you need at least 20%, though, of your own money, your own cash put up front to invest in the business. Fact or myth?
Half truth. How about that one? Depending on the type of industry. Basically, what the bank and the SBA, well, the banks are the ones that fund the loan. So what you're looking at is what the banks are looking for, and they evaluate everything based upon risk. And certain industries carry higher risks because of what you have to put into them. For example, you mentioned restaurants. You have build outs, you have policy, you have regulations, you have landlord issues. That's going to require more money from the bank is going to require that person put more of their own skin in the game, more of their own money. Whereas if you're going into, let's use a painting business, for example, where the client pays for the product up front, or half of it up front, at that point, the bank's going to say, you know what? It's a cash flowing business. It starts quickly. 10%, 11%, maybe 15%, depending on what the bank. Show us where you've got that much earmarked. Again, I always say that because people think I'm giving them a down payment. You're not giving them a down payment. You're earmarking that, putting it aside, setting it to the business where the bank can see it, and you're showing that you still have some money in reserve, usually about 20K. So that's a half, again, about a half truth.
Okay. Fact or myth? You have to pay for the franchise fee using your own money, your own cash.
Again, I'm going to say it's a myth. Okay, here's why. And it really depends on the individual situation. This is really what we get into on our consults. Um, some clients might be in a position where they might want to do that to get started early if they pay the franchise fee up front. But in most cases, we look at the financials and say, and we'll even work with the franchise and say, we can get this deal done. However, this is what it's going to take. The client may only need to put in 10% because they need to show a stronger cash position to the bank. So it really depends on the individual how we're going to structure that. But most of the time, the bank is going to pay the franchise fee at closing, and they want to pay as much as they can by invoice. So anything that could be invoiced, they're going to say, well, have you made any deposits? Have you made any contributions to this business? Please show us what they are. Okay, those will be deducted from your cash earmarked for this business. The rest will be paid at closing. And then the bank doesn't want to, or the bank wants to make sure that you still have some money left over. Usually they're going to contribute, or if you structure it right, you can ask for money for marketing, for payroll, those type of things, which would be deposited into the business checking account.
Which leads me to my next question slash statement along those lines. I've heard this. I heard this before I even got into this business, that the number one reason small businesses fail is because they're undercapitalized. Myth or reality?
It is a reality. But that's one of the things we cover in our consult. We're not looking for a client to just get funded. We're trying to set them up on a plan, a 3-year plan. Grow or go. Do you want to grow or do you want to go? You want to position yourself to sell that business if you don't like it for whatever reason, or life happens. We want to look at it at 5 years. Are we going to dominate or not? So we want to make sure that the client is properly capitalized and not shoestringing it to get into a business. And then, of course, the exit strategy we always talk about. That's part of our whole structured free consult.
And a lot of that's built into the franchise agreement and the initial startup cost expectations of the franchisor, right? You have the franchise fee, you have the startup cost, and then they build in that working capital because they want you to get to profitability as well. They want you to have enough runway to get to the point of success. So that's something I hear you saying that you definitely take into account with your candidates, your clients, is to say, hey, we want to make sure, yeah, we're covering enough, or we're borrowing enough, we're getting enough SBA, we're using enough 401k rollover to cover the startup costs, but let's also make sure we have enough runway, right, to get to profitability.
Oh, I agree 100%. And I know, Brett, you do this as well. I mean, the top consultants out there are going to encourage their candidates to do validation calls and talk to successful owners, hopefully that have been in business at least 3 years and in a similar market, and do some cross comparing. Know what product or service you're selling and who your audience is, know your market, compare it to the best of the best because they're following that process. And then you'll know on that range in item 7 in the franchise disclosure document how much money you think you need. And then we kind of discuss it from there. And I kind of play devil's advocate with the client.
Next question slash comment, myth or reality. You can get an SBA loan for every franchise possible.
Definitely a myth. They have to be on the franchise registry. Okay. Number one. That's not always easy to get there. There are rules and regulations. Some very, very good franchises are not eligible for SBA loans for a number of different reasons. Um, there are other reasons. Sometimes some franchises don't apply and don't try to get on that registry, which kind of puts them in a tough spot because they're in the business of selling territories and franchises. So that's number one. The other reason is that if a franchise has a large number of failures, and especially recently. Remember, it's the banks that fund the loan. They don't want to take the risk. They're regulated. They want to remain a preferred lending partner. They're going to say no. They're going to say, this is one we're going to pass on. Again, this kind of goes back to what you do as a franchise consultant. You're helping, you get to see things that the client doesn't know or, may not ever be disclosed to them. But, through your process, you do it. But then when they get to me, the very first thing we're going to do is check and see if the franchise is on the registry. I always say the banks are not our friends, but it does help to have friends at the bank. When you have those relationships with the bank, if I'm not sure or whatever, I can always reach out to a VP at a bank and say, hey, look, this is what I'm working with. This is what we want to do. Would this be something you're interested in? And I think that's a big mistake people make. They try to go on their own and they don't have that relationship, and that can put them in a tough position.
Statement. I should wait until I'm sort of deep in the validation process. I've already selected some franchises. I'm already in due diligence to really start to get my financing in order.
Okay, I'm going to lean on my leverage here, past experience, and I'm going to say that that's a myth, but this is based upon my opinion, and I'm going to back it up with some statements. In my opinion, I believe that if you can work with a candidate and they know that their funding is in place or what they potentially could qualify for, a limit, okay, they're going to be more focused on paying attention to what the franchise is offering in their presentation. In other words, okay, I've got the funding set aside. I should do that right away. Know that I can qualify for up to this much. Now I can focus on vetting these brands. That's an opinion, but what I see is, and the reason I base that in is I see too many people get excited about a brand. Maybe they've come on their own. Maybe a broker brought them over to there. And then they get to a discovery day, they're all ready to sign, and the franchise will say, well, what about funding? Oh, well, okay. Well, let me see. We'll go back and we'll see if we get funded. And they may not qualify for whatever reason. Maybe it's a franchise, maybe it's them, whatever the case may be. I believe you should get that out of the way right away. The sooner the better.
Okay. Just a follow-up question, not a fact versus, myth versus reality question for you. How long does this process how long does it take to get an SBA loan? What's the difference between an SBA loan and an SBA Express loan? In other words, if somebody's going to back up, they're looking at their calendar and they're thinking, I need to go to discovery day on such and such a date. When do I need to start this process? How long does it take with a ROBS? How long does it take with an SBA? How fast is an Express SBA, and so forth?
I think that's a great question. And to back up on the last statement, franchises have training dates. There's
Yeah.
also seasonability, you know what I mean? Seasonality, I should say. So going to Discovery Day and want to be in business next week. Valentine's Day for a massage business, right? I mean, you want to be open by then. So, all right. So let me back up a little bit. So let's start with the ROBS. The ROBS takes about 3 weeks. Usually we can have the money transferred before that, but start to finish, about 3 weeks in general. Most states, and there's even an expedited process with some states, so we can get all that set up. SBA, depending on whether it's an express loan, which is for business startups that don't require brick and mortar build out where you're moving walls, electricity, and all that. Um, Again, it goes with a process, and I believe our process is the best, but, maybe I'm a little biased, but we have everything structured and we submit it to the bank, and we have double checked, we've triple checked, we know that bank, we know what they're looking for. We want to make their job easy to expedite the process. So certain types of industries, I mean, heck, a vending franchise, for example, or a vending business opportunity, we can get those things through 3 weeks, 4 weeks at the most, and, something else like I mentioned, painting, home inspection, sometimes your senior care businesses, they move fairly quickly. Where the hiccups come in is where there's regulations, licensing in an in particular state. Now let's look at an SBA 7A. If you're going to get into a gym, if you're going to get into a nail salon, a hair salon, something like that, where you're going to need construction, you're going to need a real estate team. The stronger the franchise and the more they have in their process, the quicker that process goes. But let me end that part by saying the banks, once you start the funding process on a 7A loan, whether it's going to be of a new startup, they want that done in 6 months. Now, I have spoke to some franchises say, well, our process is a year. Think about that for a minute. To me, that's very foolish. I'm thinking, why would a bank want to mess with something? They're losing all the money they're looking to make if they've got to wait a year, and so many things changes, rates change, so many things. So if the goal on a 7A is 3 to 6 months, if you can get it done in that 3 to 6 months, that's about the norm. We've got them through much quicker. An existing business, heck, those things can get done in 2 weeks, 3 weeks if everything's in place.
Something, if you're watching this, to think about and take into account in terms of the timing, in terms of when to get this process going. This next one's a little bit of a loaded question, obviously understanding who I'm speaking with. But it's a question that I've often had, and I think candidates have. There are some franchises, in my experience, that have an internal team that help with financing, funding internally. They have a person, they have a go-to. So here's my question. If the franchise you're in due diligence with has the ability to help you with the funding process, just go with them.
Do I get to? It depends, because I actually do that for some franchises. However, I'm going to say that, or I'm going to qualify this. It isn't always in the client's best interest. And here's why. It depends on the franchise. It depends on their system. It depends on their source. The problem with those are sometimes a bank can get overloaded in their portfolio with a particular industry. Now, well, I'll just use the term. I'm from upstate New York, so I'll say it. You should go to my guy. I know a guy that knows a guy, right? The problem with that is the terms and who they're using. What
Right.
I found astonishing when I first got in this business is a lot of these franchise only deal with one bank. And I deal with 19 different banks, not because I want to, but because I have to. Um, Banks like certain industries more than the others. Some have minimum standards as far as how much they're willing to lend. Other ones will say, we won't lend unless it's over this amount. So for a lot of reasons, and I will say most of the time that isn't in their best interest. Um, I trust the system. I believe in working with a franchise consultant if you can. I believe on working with a franchise strategist. I'm not being biased. It's just the reason I got into this business. So
Yeah.
I guess that's the best way I could answer that question.
Yeah, I appreciate that. I was just wondering what they might be missing out on, and I believe strongly in the consultative nature of what you do. For example, you know, y- you can maybe help them think about things that the internal person for that one particular brand may or may not be thinking about. So that makes a lot of sense. Those are the main myth
May I give an
versus
example?
reality. Yeah, go ahead. Yeah, please give me an example, and then I'll ask you sort of a follow up question.
Sure. I work with one go-to bank on a particular industry, and I put the client in front of that bank. And I should tell you, I have a very strong record with these banks because I really vet them very, very closely as far as what I turn into them. And most of my loans go through, very, very high percentage. But anyway, I did submit one, and the bank said no. And I said, why? And what they came back with, the gentleman had very, very strong income. but he had multiple mortgages. He was in, he's real estate. He was doing that as part of his investment strategy. However, what he was bringing in from the clients and what he was paying out, the bank thought that DTI was going to be too high. Now that's a bank opinion. So my example was, okay, I'm going to withdraw the loan because you don't want a loan to get denied if you can help it. And then I withdrew the loan for the client. We moved it over to another bank and we say, we don't share that opinion. We think it's fine. And he's got totally funded.
Hmm.
So that
Yeah.
kind of goes to
Yeah,
both of those statements.
it does. Yeah, really helpful. Um, as we sort of start to wrap up this conversation, let me ask you this. What types of things should a candidate be thinking about even before coming to you, for example? What types of things are you going to be asking for? And I'm thinking about from the franchisor side. When I am talking to clients and we're running through different brands, the brands list their expected minimum net worth, minimum liquidity. You know, is there wiggle room there in your experience? Sometimes I've found that those aren't even necessarily accurate. What they publish, they're like, well, but we would go down to this, or actually, we really have a hard line on this with net worth requirements. So maybe just elaborate on all of this. What are sort of the minimum things that you would expect somebody to have a reasonable shot at getting funded to the level that they need to? Credit score, perhaps. What are you asking clients right out of
Mhm.
the gate to make sure they're qualified?
Well, a couple of things. Number one, we look at income because the bank's going to say, can you handle the loan payment for what you're asking? Someone might be okay for a $100,000 loan, but not at a 300 because the payment would be too high. As far as credit score, that's an overall picture of the credit itself. I mean, I've got a client now that's a 760, but doesn't have any depth in their credit history, doesn't own a home. Now, those aren't deal breakers in certain situations, but when you look at the overall picture from the bank standpoint, it is for this particular prospect. So, what I tell clients, well, let me just give you the perfect scenario. A client has good income, has good history, has their debt to income ratio in order, has their credit cards, if they're carrying balances at 35% or less each card relative to credit card limits, um, has their let's see, would be in the right area where they're not pigeonholed in. In other words, they're going to look at the competition. The bank will do that. Most people don't know that. The bank looks at the FDD. So if somebody has all of that in a row, if they have their personal financial statements, they have their credit, if they have experience in the business, it's not as necessary with a franchise because you're buying a business in a box. But if they have management experience, if they have training experience, the bank looks at the overall picture. Also, coming prepared to the bank, ready to respond to them in 24 hours when they reach out to you. You don't want to end up in that file over in the circular section over there. So preparing a client, I think, is critical because if an underwriter reaches out to them, they've cleared packaging. They're in the underwriter stage, but if they don't come across well, or they don't think they know the business very well, or they're not familiar with their projections, which is something that we help them with my background in operations, if their business plan doesn't match that, those are all deal breakers. So I tell a client initially, say, let's get you prepared. Let's make sure we got your credit cards paid down. Let's see if there's any hiccups on your credit report, which I pay for to look it over. We get one of the big three. If there's any hiccups on here, let's say, I'm not comfortable turning this in unless we get this cleaned up. Let's do this. And then I explain how they can do that. The next thing I'll take a look at is what is your long-term growth strategy? Are you looking at one unit? Are you looking at multiple units? That's another thing. The bank only wants to finance one at a time, but there's a few tricks to that where they can actually secure multiple territories and, build out one at a time. So that's another whole conversation. But I guess the perfect client is prepared, willing to trust who they're working with, and willing to be totally upfront. We don't want to find anything out down the road. And it does happen. Sometimes people say, oh, yeah, I didn't tell you that. It's only as good as the information you give me so I can prepare that strategy for and say, hey, here's our options.
You've mentioned twice now having good income as part of the equation. What about somebody, though, who finds themselves laid off, which is a big
Mhm.
situation right now, and instead of going back to corporate, they're thinking maybe I'll start my own business. So what do you do if you don't have an income currently? Or if somebody wants to literally quit their job to go all in on a franchise? Hey, I've got a little bit of runway, but I'm literally exiting my business and I'm going all in on this business. How do banks handle those two scenarios?
I first thing I would say is don't quit your job until the loan goes through because that just strengthens your profile.
Okay.
Absolutely fine to quit when you do. You know what I mean? I don't like people to quit before because now they're going to say, again, that's one of the factors they look at. Let's talk about somebody that doesn't have income. If they have good savings and what the bank is looking for, depending on the brand. Here we go again with like a service related business. If it cash flows quickly, if they have some decent savings, we can say, okay, can they support themselves and their normal, incoming and outgoing expenses? Can they support themselves? Is there enough money to make the loan payment? And is there money left over? And can they do that based upon their savings for, let's say, 6 months? Depending on the industry, that's when we can get through. Another one would be if they have the IRA and 401k, we could look at that and say, okay, you still only need the 11% in, but we're going to need to do that rollover to convince the bank that you've actually have this money set aside so you can pay your bills because you don't have income coming in. Now, people will say, well, why do I have to do that? And I'll say, well, number one, because the bank can't touch your retirement account. They just can't. So they want to make sure that you've moved that money over, done that rollover, and committed it. Now, if you don't need that money after the fact, you already have a retirement account. Put it back in a retirement account after you get the loan. So that's how we would approach that. Again, that's talking strategy. There's
Yeah.
also a gift option. We didn't talk about that. Um, Family, friends, fools, depending on the bank. Somebody wants to give you some money, um, they would sign a gift letter, and that would also be one way that we could leverage that and see if we can get a bank to take it.
Yeah. So the whole point is there are options. And I
Yes.
mean, if I'm gleaning anything from this conversation, it's that working with somebody who understands all of this, who knows this, who has relationships, right? And maybe this is like the final myth versus reality. Like, why can't I just go to my local credit union and try to do this, right? Because it sounds like some banks understand franchising better than others. You talked about how they might even look at the FDD as part of making their decision. I don't know if my local credit union is going to understand how to do that in terms of making evaluations of how quickly I might be able to cash flow and all of those types of things. So maybe I answered my own myth versus reality.
Well,
I guess the point is there's some value in working with somebody who knows and understands this stuff.
yeah, that's you brought up a good point because I do run into that a lot. In fact, I ran into it yesterday where the client said, well, I've been working and I'm going down to my local bank. Well, do they fund a loan from that location? Does it
Mm,
have to go up through the corporate ladder? Too many cooks in the soup. The other problem is a lot of banks will take SBA applications and they'll farm it out to a bank that does the loan for them. The more people involved, you don't know all those things we talked about. Do they like this industry? What are their standards? Just because that bank took that on, and said, hey, I took this application. Now I send it over to another bank. Or if it goes up to the corporate office, they might look at things completely differently. I should mention the only banks I work with fund the loans from those locations, and we only deal with decision makers at those banks, period. That was one of the biggest lessons I learned right there.
yeah. Well, I have found this conversation enlightening. Hopefully, if you're watching, you've learned something and have a better sense of how to go about it. And I imagine part of how you go about it is by talking to Al. So, Al, what's the best way for people to get in touch with you and engage you to help that to enlist you for that initial consultation to decide if and how to move forward to fund their franchise?
Sure. Easiest way is email, and it's al@fundmyfranchise.com. We try to make it pretty easy. Of course, that's the same as my website, or you could reach out to me. My office number is 541 831 0071. So
Sounds
Anyway,
good.
that's the best way to get a hold of me, and usually I respond within 24 hours.
Cool. And I'll put all that contact information in the notes below. Be sure to mention that Brett at Franchises for Fathers sent you so that we understand that. But wish you all the best of luck in your franchise journey. If there's anything I can do to help support you, to help you find a good industry, a good business that's right for you, reach out to me, Brett at franchisesforfathers.com. But if you're ready for the funding conversation, Lesko is your guy. Take care, everyone, and we'll talk with you again soon.